Hey everyone, what's up? How's it going? Welcome back. Thank you for joining us today for another episode of what I personally consider to be the greatest podcast in the world, although I am a little biased. Armchair ESG with Nate and Yates. With me, as always, my partner in crime, Mr. Nate Najjar. How you doing today, Nate?
Doing good. You know, End of the summer, kids are back in school. We're baking and shaking a little bit here in the South, but
Yeah, I was gonna say
it's all
nice and
good.
cool in the Dallas
Yeah,
area, right?
yeah, yeah. How are you?
I'm doing very well, thank you. Excited to be back. We've been trying to get this one recorded all week, and it just kept getting pushed. And so happy to be finally doing it because we got a really interesting discussion today, which leads me to our next guest, one of our favorite guests to have. Again, Connor Platt of Confluence Analytics, CEO and co-founder. How are you doing, Connor?
I'm good. Thank you for having me.
Oh, absolutely. I can't wait to get into the discussion that you've done today. And that leads to our final guest taking time from what I know, because I see his calendar is an incredibly busy schedule. Our leader, our CEO, Ben Webster. How are you today, Ben?
Yeah, I'm doing great. Thanks for the nice intro.
No, of course.
Excited to be on
Thanks
the
for joining.
podcast. You guys are doing great.
We're working on it. So we have some interesting stuff to get into today, looking at sort of the relationship between ESG data, ESG signals, and how it fits into a mainstream investment narrative. But before we really dive into that, I want to build up to it. And so, Ben, with you and Connor on, I was hoping you could just give everyone listening a little background on how you met Connor and how this relationship developed.
Yeah, no, Connor, I think we've known each other now since maybe 2017.
Something like that.
Maybe late to 2017, early 2018. And we just met through, frankly, I think we either were introduced by a mutual connection. I think that's what it is.
It is, yes.
And Connor had built an amazing ETF. It's still out there and doing well. What's the symbol? It's ETHO ETF, right?
That's correct.
I just didn't remember the ticker symbol. And so he's had just years and years of experience in building financial products that incorporate carbon emissions and ESG data signals. Where we as a company, while obviously what we do is investment tangential, our focus is providing amazingly great, accurate, up-to-date, objective ESG data. And so the combination of us figuring out how to work together to build to help Confluence with our data, for them to build analytics and signals to help investors invest better, was just a natural combination. So Confluence has been a partner now, a client / partner for 5+ years, and I believe Connor and his team know the intersections of ESG data and how stocks trade, how stocks perform, probably just as well as anybody that I know. And I've met a lot of people in this industry. They're doing just amazing stuff, and we're excited to continue the partnership.
Thank you.
So what we are really trying to make the case for, and we built this for a while now, is that Connor put it very well in a conversation this week. He was like, there are some people that think really complicated analytics of stock are just voodoo as well. So all investment has risk. I mean, every return is a risk-adjusted return, really, right? If you have more data that gives sort of reasonable insight or some predictive ability at a margin at a level better than 50%, then that's useful data, or maybe less than 50%. I don't know. Some people, I mean, there's trading strategies out there that rely on like the phases of the moon, and I'm not exaggerating on that one. So, Connor, last time we talked about what we are calling, and you coined the term, I love the term, climate adjusted yield, because it's just another risk adjusted yield. But continuing on this narrative, we've been building about fitting ESG metrics, actual data, and it's where our partnership comes from, because we put forth that we have the absolute best ESG data, and we are really attempting to transform how the market uses this data in every way. And you give an incredibly value insight to investors to how to incorporate that. So in this episode, we're going to talk about another aspect, which is shorting stocks. So for those who don't know, before we get into the analysis, you want to explain what shorting a stock is?
Sure. So some people may have heard the term "don't sell yourself short." So that comes from shorting stocks. And what that means is, let's say you were to short the S&P 500, you essentially would short today. Let's say you short 100 shares and you are essentially getting the cash. You're selling those shares with the hope of buying them back at a lower price. And in selling the shares, you get the cash. And sometimes you're paying to get that cash. Sometimes you're being paid to get that cash because it's a loan. And you can use that loan either to invest more, which would obviously incur some more risk potentially, and or to just sit on the cash and earn a return. And generally speaking, people who short stocks will be buying them back lower or higher. When you short a stock, you are incurring a lot of upside risk. So you have to be pretty sure. And when we all began this ESG journey, Ben and I and others, I think this idea that ESG being a better source of downside risk or risk overall is something that we just kind of continued on that path and actually just used the infrastructure and the knowledge of factor investing. And we've talked about this before in the past, but that's a big way we do this is we take the consensus data, the very rich and consensus data of OWL, which has a bunch of sub variables that build up to the pillars of E, S, and G. And we use that and the changes in that combined with residual returns to really ferret out where a stock might go in 12 months from now. And we're going to show how that has worked on the downside if you were not just avoiding downside risk, but actually seeking it. What kind of stocks would you either be short or would you avoid? And this year has been an interesting year for shorting stocks because there's been, at least in the beginning of the year, some really exciting things that this combination of variables happened to uncover and we published on at the time. And now it's actually kind of showing a much more diverse, broad set of companies. And I guess we can only give the insight that perhaps that's more of a market overall call. There isn't just some sector. It's a lot of very large names that we all know at home, and we'll talk more about them. But yeah.
So we're going to talk a whole lot more about those. And I actually do want to explore the risk of shorting a little bit too, but you made me think of something. I want to throw a question over to Ben. So one of the, and we know this well working at OWL, one of the driving factors in how you created our products was you want to take the subjectivity out of ESG analysis. And when a purchaser of ESG data, generally an investor in this scenario, is relying on scores, it's almost impossible to take the subjectivity out. So as we're exploring things like which stocks to buy or now which stocks to short, how important do you think it is to be ruthlessly objective?
I do think it's important in anything to try to follow the data, right? And anyone who understands and works in math or science understands that you want to do your best when you're setting up an experiment, when you're doing research, to isolate variables, right? So how do you do that with ESG? Well, the way you isolate variables in ESG, the best way to do that is actually to get the source data. What's that means? Like, hey, you want to look at what are the actual carbon emissions of a company? Like, what's their metric tons of CO2 equivalent emissions per year? Or, hey, what's the actual gender pay gap amount? Or how many injury rates per employee, or whatever it may be. That's the best way to do it. When on the opposite end of the spectrum, when you have scores and ratings, there's a huge subjectivity involved in that, right? With our consensus scores, and which is one of the things that so the one of the main products from OWL that Connor and Confluence integrate into their analysis and into their analytics, the way we've tried to lower subjectivity, and there's still some subjectivity that exists in it, is really twofold. One is to gather the subjective opinions of numerous sources and aggregate that and try to identify the commonalities and optimize around the commonalities and smooth away the subjectivity. That's a flowery way of saying it, but you know, there's a lot of research that goes into that's evidence that shows that the wisdom of a crowd of experts, a large majority of the time, outperforms the any individual
It almost
expert.
becomes the objective data, even though it's a compilation of subjective data.
Yep. But then another way to look at it is we're also aggregating just a lot more information, right? And if you really think about what ESG is at its core, there are, how do I say it? There could be hundreds of material issues that are ESG related that a company faces, right? And some may be more material, some may be less material, some may be perceived to be material but not material at all, right? Because it's a subjective world we're living in here, right? But with that said, not only are we aggregating the different views from companies, we're actually just aggregating a heck of a lot more data. And so as a result, our scores incorporate, how do I say it, a much richer or more dense amount of data regarding companies' behavior as it relates to ESG, and a company's performance as it relates to ESG. And that data density, I feel, you know, it smooths away the subjectivity, because you just have a lot more data to quantify that behavior. So that's how we look at it. Do we do it perfectly? No, no one does it perfectly. But if you're going to look at a subjective rating methodology, I'd rather use ours because it's much more data rich than any other methodology out there.
So that was actually the answer exactly that I was hoping you would give. And the reason it's important is that because we're about to jump into how we can use ESG signals to potentially predict shorts. And I want to caution everyone listening, and also in parallel express how excited I am about this. Shorting stocks is dangerous. If you do not know what you're doing, it's dangerous. So Nate, do you remember the Wall Street Bets GameStop situation a couple years ago?
Yeah, there's a movie coming out shortly about it. With,
I can't wait. I was screaming freedom at
awesome.
the other end, but so what happened at a very simple level is some hedge funds had shorted stocks, GameStop in particular, AMC, a few others, and they were known for going in looking for companies that were failing and shorting these stocks. So I think they had bought GameStop. It was like 10. They were betting it would go to 6, something in that neighborhood. They'd make $4 a share, but they owned a whole bunch of shares. In fact, they were doing something called naked shorts, which are supposed to be illegal, but that's where you short stocks you've already shorted. It was 140% free float, but separate discussion. What happened is everyone on Wall Street Bets went and bought GameStop, and they drove the share price up over $400. Now, if there's a margin call, if they're said we want to buy those shares back, all the hedge funds holding those shares have to pay that $420 difference. When you own millions of shares, that's a lot of money. Melvin Capital went out of, they went bankrupt, and Citadel, I think they had 20 billion in losses. Like, it's a big hit. But what is exciting about this, and kind of want to get your thoughts on this, is that this is sophisticated investing. Like, this is a way to use ESG signals as a factor in truly sophisticated investing.
Yeah. So it enables basically the ability to do the sophisticated stuff that we do in other parts of the market. And it's just funny listening to Ben, and we've been knee deep in ESG data for way too long. But even when I worked directly on Wall Street, one of my many jobs was being involved in earnings analysis at Brown Brothers Harriman. And they spent an incredible amount of time and effort, and we're quite proud of the earnings analysis that they've done since the beginning of time, which the biggest feature was actually doing what happened at the time. And this is also an issue in ESG that Owl serves well, but essentially it's not survivorship bias. It's not anything. This is what actually happened. This is the write downs that actually happened. This is what was known at the time. This is what investors actually knew, not what you look back and see. And it's note every day is the same. It's like, it's messy. Like, it's messy now, and it was messy then, and it's a little less messy, but it's still a lot of data, and how do you make sense of it? And so there's pretty well worn past. It's just a question of, having the will and the way and a lot of different relationships, and OWL certainly makes that a lot simpler. And we have been producing forward-looking forecasts of ESG variables on OWL, which is something we're going to do more of. And by doing that, we can also, using factor analysis, and we'll get into more of the details, but effectively, we can make a forecast based on ESG variables of where we think a stock will be relative to the other stocks in 12 months from now. And if nothing else, what this is tying ESG variables to residual stock return risk. And what that really means, what residual stock return risk is in plain English, is that for a long time, you've been able to take any stock in the US and look at its returns and figure out how much came from the market, how much came from its industry group, how much came from its size. And what's left over is this residual return, which is
It's an isolated variable, just like Ben said.
It's an isolated variable, exactly as Ben said. And when doing that, comparing to ESG variables, you can begin to create models and make predictions and track those predictions to see if there's any valid reason to follow them over time. And like every other thing, any given month, it's not, 100%. And what we're going to do is talk about one variable where we do that specifically, where we take a bunch of things and make a forward projection. And then another variable that's really just straight up an OWL ESG variable. And it just happens to be the social rank. And it's the ESG variable that when you start in ESG investing, at least Ben and I, when we started in ESG investing, is the fuzziest of all of the variables by far. And it is exactly why consensus scores are so valuable, because you can make a very strong case that the G variable, at least the data, has existed longer than all of the other variables.
I was working on just that part for a long time.
Yeah, and the E variable has a perception of it being easy, I think. It's certainly the most tangible, is why it's viewed as easy, whereas social is not necessarily complex, but always complex for investors to
It complicates the situation.
It's very simple in certain industries. Walmart has over 200,000 employees. Their social ranks are really important for maintaining that sales force and for delivering a high quality service product. So it depends on the industry and its value.
You actually is a good point. And so we got Ben on here so I can pepper him with questions that he's not expecting. I'm really excited for this. So I have noticed in our social component, there are factors that you don't think about when you talk about social in the sort of popular discourse, and it's like labor relations, employee accidents. Like, what gave you the insight to add those things? Because I'm working on a study right now with someone else with Terry specifically, and it looks like those correlate much more strongly to performance than some of the ones that we're told to pay attention to.
Yeah, it's actually a pretty simple answer to the question. It's just like, if you look at the wider view of social, or I shouldn't say wider view, but more of like breaking out what social is. Social is a better word for S than social is stakeholder, right? It's your employees, your vendors, your customers, the communities you operate in, your investors, even regulators, right? We just, the simple answer is every single data point that was being provided by our sources on each company that had anything to do with a stakeholder, right? And it could be literally the community. You have a office in Timbuktu. Are you contributing charity or in that area or helping that community in some way, right? But it just anything that was remotely tangential, related to a stakeholder, we just decide, and it was provided by our source, because for us, we let our sources determine what data we deem important for a company. As long as it was source provided and it was related to a stakeholder, we included it, right? Because remember, we're not making our own decisions on what's relevant. We're letting our sources tell us what they feel is relevant, right?
And so that's the really interesting part of it, because what I'm trying to sort of suss out here is the nuts and bolts of these signals and why they drive. So Nate, let me ask you a question. Working on product and doing the data updates and looking at all the data that comes in, how different is the reporting and the availability of data on stuff that's well established in every sustainability report now? You know, we're going to get scope 1, scope 2, probably scope 3 emissions. You're going to get water usage, some other things like that. But this wide variety of social or stakeholder inputs.
Yeah, no, that's a good question. I like that term stakeholder, Ben. So, and that's noodling in my head now. I think that's exactly right. So, yeah, the environmental data, and like Connor said, some of the data has been, there longer than others. When it comes to stakeholder or, lost time accidents or, employee morale, it's there, it's getting better. But what's great about what we provide is clients can see based upon, our IQ data, who's disclosing what, right? And that kind of drives more participation of disclosing those data points. And I think we're going to see more and more of that as companies compare themselves to others and go, wait a second, these guys are disclosing these S data points at a faster rate. It's really starting to push the market to go, boy, we better get on this and start disclosing it. And once that happens, clients are going to ask, where is this data? In fact, one of our managing directors out of Europe today was like, hey, we need to see our coverage. This company is wondering across these companies, what is our coverage? What is the other company's coverage across this S data point? So we're starting to see the market actually pushing itself to self-disclose that data and get it out there. So it's increasing, and I really believe it's going to increase more and more. And we're really working hard to make sure we're grabbing those data points and finding as many sources around those data points as we can.
What I found fascinating about it, as I looked through your analysis and your recent quarterly report, Connor, is that it actually kind of makes sense. If you're doing really badly in the social side, that's an indication that something's not going well operationally. But you use two signals in this. You use the social signal, and then you use the carbon emissions 3 signal. So you want to explain what made you choose those two, or is it just analysis that drove you there?
Well, we just looked at all of the different, we every month, every quarter look at the returns of all these signals. And when you can see what you see over 3 years is that the carbon signal 3, and we can get into the construction of it, but that is a signal where it is using the residual returns to make a forward forecast, has exhibited lower or underperformance versus the market over 3 years, and so has social. And when you combine them together, you get a better result. It's not always the case, but and in doing so, we had been running a model for quite some time. We'll show you the results, but essentially this year it was picking up, at least in the beginning of the year, it picked up all the banks, which in retrospect was a little interesting, or rather the smaller banks of the larger banks, SVB being one of them. And while SVB was known as having a good overall ESG score relative to other banks, which is true, that they still, for a variety of reasons, have a social rank that is less than 50%. And that's in large part because they're in a big pool of the Russell 1000.
That was your February analysis?
That was our February analysis. So that was year-end signals, produced a portfolio of a short portfolio based on those signals of about 30 or 40 stocks. And one of the sectors that really stood out at the time, and there were a number of other companies in there, were banks just generally. Yes, this is a good picture of it. So this was published in February and on a signal that was generated in January. And SVB and Signature Bank, you can see Signature Bank in the lower left-hand corner, SBNY. All of those banks, about 2 weeks after making this public to people beyond our clients, were put in receivership, essentially. There's lots of reasons for that. Our group certainly has a lot of more on the digital crypto side, so we viewed it as a crypto crap gown, explicitly combined with the liquidity crisis. So, but that's a topic for another day. But really, it's, as you see on the screen, it is a social rank that you can see. All those stocks are lower than or around the 50% mark, and then a carbon signal 3 rank. I think here we're just focused on financials, but there was a larger group of companies that were part of that short, and right in the middle is SVB. So, but this model hasn't just gotten this right. This isn't just sort of a one and done. And then also importantly, this model is shorting all of these stocks equally weighted. So there isn't some, we were short Silicon Valley Bank as much as we were short Zion Bank at the time. So the performance is an average performance when you see the line. Actually, if we go to the next slide, when we published in April, the stocks that came up, there were a number of them, but in April, News Corp, which is not to be confused with the Fox TV part of it, but actually the newspaper part of it. Nonetheless, in April, June is when the Tucker Carlson thing blew up. Clearly, the social and carbon 3 ranks aren't predicting these sort of very specific events. What they're predicting is that these companies were in trouble. These stocks had issues. In general, from a return perspective, they weren't high flyers. Live Nation was another short and at the time, going into the summer concert series, that probably struck some.
Oh, true.
Yeah. So now we are in a world where it's not so much this same short model. It's not so much that it's picking any one particular sector, and there's only about 20 or 24 stocks that are actually, part of this. But through the year, this equally weighted, very straightforward, not trading oriented model portfolio has underperformed. And in this case, this is what you want, but it's
exactly
underperformed by about 1,600 basis points. So it's been pretty consistent. So it's a way of saying that there are some pretty straightforward ways, once you have the consensus data and a bunch of signals on top of it, to look for more creative ways to find downside or just ways to avoid some stocks. And what this model is telling you now, in some of the larger names that are out there, and I believe ExxonMobil, Tesla, Moderna, a bunch of names that people know at home, Amazon being one of them. And I guess this is interesting because we published this piece and then the next day Amazon beat earnings. And then, as you can see, we have a lot of technical analysis in there. I think it's like the second or third slide. But this is kind of, yes, this is a mix of it now. Moderna down at the bottom here. This is a price momentum. Moderna has been going lower, but it's an interesting mix of more diverse large companies. There isn't some sector that is running through this. It's a mix of large companies, and thus far since August, almost every one of those companies has gone lower and gone in the direction. Even Amazon traded up to the resistance that we predicted it would. Our analyst Scott Davies is a CFA, CMT, and certified sustainable analyst as well.
Nice.
Yeah, he's a triple threat. But what this is saying is these are stocks, and there's a number of other ones that we could highlight that are ones that a normal investor would just avoid or be underweight. And this is an example of how ESG can be helpful through time. It's even more helpful at the sector level. There's certain sectors where a low social rank without any other signal can highlight an underperformer, because the social rank in that category is just so dominant in terms of the day-to-day operation.
Ben, you had a follow-up question?
Yeah, this may be taking a slightly different direction, but I know one of the things you do with our consensus scores is you use your analytics to predict the momentum or the future price of a consensus score. Correct?
Yep.
Is that how, what part of is this? Does that play a part in all of the analysis, or what?
Yeah,
what,
so let's talk about that. So it's really kind of two parts. So for ESG consensus score, so Microsoft's ESG rating, or its E rating, just to use an example. So we can, using a pretty straightforward statistical analysis, make a prediction of where the E score is going based on how all the other ESG variables are going right now, and with some sort of level of predictability. And so we do that as an input to the return forecast as downstream. But in and of itself, essentially, because we have a consensus view and a lot of it, then we can, like you would do with an earnings projection, you can do an ESG ratings projection. And that is very powerful, thanks to OWL, because it can give people a tangible leading indicator, if you will, of where the risk is. Signals are a little bit different animal, and it may make sense now, Rob, to pull up that slide 25 of just showing how it's constructed. But effectively, where signals and that ESG forecast differ, yeah, perfect, is that the ESG forecasting where Microsoft's ESG variables are going to go, you don't need to know what residual returns are doing at all, right? You need to know what all the other companies are doing and what Microsoft is doing. Because it is true, essentially, that Microsoft's ESG score is going to rhyme with something that it has done in the past. It is
but you are then, I know you said it's nothing to do with the price, signals, but then once you have a signal on where forecast on where the ESG metric is going, you then use that to tie to your price projections.
Correct. Exactly. That's a great way of thinking about it. It also becomes an input into this general recipe. And so the recipe and all the data ESG wise is OWL. And so it's OWL ESG variables. And I always quote this, so we can change it afterwards, I guess, but it's about 64 variables in all. We treat them all generally equally weighted. And then it's the changes of those variables. So the 3-month, 6-month, and 12-month changes of those variables. That's our input set, if you will.
The predictive changes or the past
changes. Just truly the lag changes. So how the 12-month thing and through time. So how it's changed 3 months, 6-month, 12-month, and the variable itself. And that is all contained in that ESG variable. Same with carbon. Carbon is the emissions data and the changes in that emissions data. And residual returns is what we talked about originally. That is a stock level return with all known factors stripped out. What you're really doing is using machine learning at that point to look for relationships between the changes in those variables and the variables themselves and residual returns to say, can I, with some predictability, make a forecast? And that's what we do. That's basically what factor investing is. It's just they're using things that people are used to using, like PE and this, that, and the other thing. It turns out that more often than not, it's kind of wild. Anybody can get that data, and yet when they do something that anybody can do, they think they've found like some new territory. Go ahead, Ben. Sorry.
Yeah, what I really find interesting about what you're doing. So I've been in the ESG, Al's been around for over a decade at this point, right?
Yeah.
And a lot of the research over those 10 years has indicated that the absolute, ESG rating of a stock is not extremely material to returns. It's ESG ratings momentum. But what most of the market, when they look at ESG ratings momentum, they're looking at the change in the rating, from some period in the past to present, right? One of the things that I think, and that's the research supports, pretty much unilaterally that is a good way to use ESG in investment analysis, right? That said, what I think you're taking it a step further, you are looking at the momentum of the ESG scores, but then you're using it to predict future momentum. And if you just look at just basic investing, investors are always looking for some sort of information edge, right? So if the predictability, if you could predict where the ESG ratings are going, right, then you're also predicting the continuance of momentum, right? And then tying that into the price and just to some extent is you're mapping ESG directly into future price predictions, and you're basing it on research that has been proven so far to be a great way to use ESG, but you're adding this extra component of future predictability of where those ESG ratings are. I think that's great because I don't, we work with a lot of different hedge funds, etc. I don't know anyone else who's doing that, which is a very interesting approach.
Well, we bumped into a few hedge funds that have, and some of them have become our mutual clients.
Nice.
But what also is just the case is that this is how you would use ESG to supplement and make actionable in an investment process. Because with full admission, if ESG is a factor, it is a small one, right? And it goes in and out. But in the game of investing, which we all service, it is a game of inches. So that essentially ESG, in treating ESG as a factor and making this forward prediction and doing that work, it allows quant funds and other investors who, and I think we've talked about it, but it's worth repeating. We treat ESG as a factor with the full knowledge that there are very well understood larger factors in the room. But in a game of inches, which is what investing is, and at the sector level and at stock A versus B kind of decisions, this is an incremental benefit and edge. And that is the idea. And the fact that you can piece these things together and produce a pretty consistent underperformance, it says something. It says that, yes, you can make this actionable. Yes, you can ferret out if you're creative enough to find ways to find hidden risk, essentially. So it's essentially unlocking. We have collectively over these years helped unlock making ESG more actionable and more accessible. And it's been exciting coming from the traditional investing world to see a traditional portfolio manager see our grids and say, okay, even when it's almost better when they disagree, because at least they're coming at it from a point of understanding and they ask better. People who disagree ask better questions, basically. Has been my understanding. And generally speaking, they quickly come around to seeing how this could influence certain aspects of the various companies that they own. And most people in the investing world are pretty open to the fact that there's a lot of stuff going on that they don't quite have a handle on. None of us would say that too out loud, but like that it does help in terms of triangulating where things are going. We're just another piece in the puzzle. So yeah, I'll kind of leave it there. I think we hit that.
I wish that was a general approach, right? To the way people look at things. Like, hey, people who disagree with you, listen. They may ask great questions. You can get some good information from them, right?
But you've always come at this a lot different than the tradition. We all know the ESG is rooted in on the religious side, meaning literally originated from religious-oriented investors. And I don't think it was those folks, but some group in between us, Ben, really made it like this is how investing is going to be to the institutional investing world. And I don't think that's ever how it works. What's true is that it's true as day. When I started on the street, the S&P 500 was one thing. It is now mostly intangible services, royalties, and assets. And while it may not be perfect, it's an evolving data set to get around that and tie it to financial data and returns. And so, you know, I know that Al is perpetually on a quest to having more relevant and new data, as we all are. And the reason is because it's that's the task at hand, is to make sense of an ever-changing world.
Well, that's and I got a follow-up question both for Nate and Ben, because you interact with our clients more directly than I do fairly regularly. So the investors who are truly interested in driving their values, it's much easier to have the conversation with them on the importance of ESG data, right? Like if you want to limit emissions, yeah, you need to know how many emissions there are. But I obsess over the whole rest of the investment world. And it's not that they're necessarily against sustainable investing, for example, but they're value driven. If they're not making money, then they're not interested. But there's a flip side to something like this, and I'm curious what you all think in terms of something that the way our clients think. If you can use signals like this to predict that stocks are going to fall, is there an argument that they can make to portfolio companies in engagement that, hey, here's these signals, this tends to correlate with falling stocks, why don't you look into changing this operationally?
I think without a doubt, I think you have to look at the type of investor and what their time horizon is, right? And so I've talked from investors that are like even day trading, like coming in out of trades. Talk to investors that have like 2-day time horizons, week time horizons, and all the way to holding to for 10 plus years time horizons, right? And then there's quants versus fundamental investors, and fundamental investors with more concentrated portfolios are more likely to engage, right? I truly believe that ESG is very much an operational issue. What I mean by that is any company who is in business and is doing their best to figure out what are the decisions I need to make to either maximize my profit, reduce my costs, operate more efficiently, right? And ultimately, if you have a longer term horizon and you're an investor with a thesis that there's something that's materially relevant for that company, you definitely want to engage with them and have them improve how that company operates to whether it's reducing injury rates in the workplace. Hey, you can get sued for that. Want to reduce that, right? If you're a mining company and you have most mining companies have high water use. Okay, well, your access to fresh water is this, right? When this runs out, right, or water prices go up, whatever it may be, this is a huge risk for your business. Maybe you should figure out how to be more water efficient, right? I think when you actually get down to the details, no one would argue issue by issue, is this relevant or not when you're looking at an individual company, looking at individual issues. What Connor and Confluence is doing is they're looking much broader. They're looking for investment signals across different groups, across, it's a different approach. And at the end of the day, I think what Connor's doing is appealing to investors that probably have more stocks in their portfolio, who are probably looking at things from a factor basis and looking to make decisions based on, well, where's momentum going in the market, where's leverage going, and what have you. And when you look at ESG as a factor, right, are there factors in ESG that are predictive of future returns, right? And at the end of the day, the best way to say this is that's very relevant to all of the market, right? Where the investors that don't care about values-based investing or ethical-based investing, they just want to maximize their return. They're always looking for an information edge. Hands down, always looking for an information edge. The problem is not in it's identifying what really is truly an information edge, or what's a spurious or just something that's correlated but not causal, right? And so what the advantage of what Connor's doing, and why Al is a good help there, is that we have a long point in time history, across a broad universe of coverage, updated every month, right? With our consensus scores. And that allows him to have a much more data-rich research environment. Secondly, Connor and Connor's team, they understand that you can never look at ESG in isolation. You have to look at other variables, and you have to look at about how those variables could interact with each other, right? And cause changes in each other. And so you just have to have a lot of experience with this type of research, a lot of experience to understand how the factors work, and how other investors use those factors to truly ensure that you're providing a valid, a non-spurious signal to the market. And so it's easier said than done. It's really, really complex and difficult, but I think they've cracked the code, and that's what any quant wants. I'll leave it with this, right? We can take our data to a quant that invests in the Russell 1000, and that quant could come back and go, we love it, we found tons of alpha. I can go to a different quant who invests in the exact same universe of companies, found no alpha, right? So the method, we didn't find anything. So it's not because they both could be right.
Yeah.
Right.
And I want to be very clear, because they both could invest in the same universe, but they can have vastly different investment styles. They could be looking at different factors. They can be having a higher frequency turnover, longer term horizons. And so the best you can do, and I think that's what Connor and Confluence is doing, is provide a very transparent signal on how it was derived, right? And try to isolate as many other variables out of the equation as possible. And that's what they've done. And that allows those quants to take that information, understand where it came from, and integrate it seamlessly into their process.
And to add on to Ben's point, and this is the reason that Confluence and Owl really have done this together, is that number one, we knew we weren't burdened at Confluence with having to have a narrative in the sense of this product needs to be this thing, whatever that would be. We just needed to see if there was a way to take returns and ESG variables and figure out, long or short, that there was alpha, there were actionable ideas and things you could do that could supplement things. And both from a economic standpoint and from a practicality standpoint, in terms of the consensus scores, was not possible 5 years ago. It may be possible now, but it's not possible both from a data and an economic standpoint, having built several ESG products. And the angle always is, you'd like to have more providers, but the more providers you have, it makes it economically impossible to launch the product. Ben invented Owl because of that, right? And so among many reasons. And if you wanted to take this kind of approach where you wanted a lot of variables through time that you weren't sure if they mattered, but you had a way of figuring out what mattered at the time and build on that, which is primarily what we've built. And now we're going to take it a lot of different directions together, but that is the combination of things that happened. Because previous to this, I built products beyond Etho where we use different providers, and every day, as Ben can tell you, every data provider is very good in their own right, but they have their own view and they sell it that way, and that is what it is. It is very similar to when you buy earnings analysis from a bank. You are buying it from their analysts. They have a view. It might be great, but it's a view. Even if it's great or if it's really bad, that's good to know.
I want to add to this. I talk a lot about operational, how ESG can make, if a company's, it identifies their material ESG related operational risks and opportunities, and it figures out a way to do something about them to improve how they operate, right? There's a whole other way of looking at this that is valid, and it's not contradictory, is the perception of the market, right? Of you as an ESG performer, and also what is the market doing with that information, right? So like, for example, in a company can have great operational efficiencies and have reduced all their ESG risks, right? And the market could have greatly rewarded it for that. So much so that it's now a company that is ripe to short because the demand for high ESG stocks has driven that up, right? So some of the analysis, how should I say, the quantitative analysis that Confluence is doing is taking all of that into account. They're looking at the other fundamental variables about that company, and if they're identifying that something's overvalued due to ESG, you're going to see that signal. And I think one of the biggest problems in the market, and because I talk to so many hedge funds, is the risk of crowding, right? That's what you saw with GameStop, like when we were referring to GameStop in the past. So what you can use the Confluence metrics for is to see these signals, and that's why you don't want to look at the absolute ESG score. You want to know where the ESG score is going, but you don't want to look at the ESG in isolation. You want to see everything else is going on, and it really creates a good decision-making mosaic to take all those into account, and you could see it's working. It's working very, very well.
Let me follow up on that. I want to ask Nate a question. Nate, you've been quiet today. I'm not letting you off the hook. I know it's Friday, but
Yeah, no, I'm
So-
here. I think
No,
I'm learning more in this podcast than ever before, especially with
That's-
shorting, right?
I'm giving you a hard time anyway. But one thing that you and I talk about on here all the time is that if we're ever going to see any sort of change in the way companies approach our planet, it's going to be market driven. So as you work with data and talk to clients, it's a two-part question. One, how big do you think the disparity is between what investors want to see in terms of corporate behavior and what companies are actually doing? And two, how influential do you think something like this can be in terms of putting a quantifiable correlation between positive ESG related steps and, if not driving positive return, at least avoiding negative return?
Yeah, it's a great question. So if you go to Connor's last slide, I really love this slide on the slide deck. And the title is "Our Signals Lead to Better Outcomes." And I really love this slide. And a couple of things. Every client we talk to wants to do better, right? Whether it's financially better, do better by their employees, right? Employee retention is a huge topic of discussion today, right? Employees need to be happy and well taken care of, and they want to feel like they're on a mission and part of a company. It's a big deal, especially with this younger generation of millennials going into the workforce and younger than them. So companies need to pay attention to that. And so those signals leading to better outcomes is key, and that's what we're seeing with our clients. But part of that is better data, right? What is the true nature of the data? And that's what we're focused on. So we can pass it on to guys like Connor to come up, with these creative ways of presenting information for decision makers. And that last line, our signals determine stock performance and risk without regard for narratives. That's really the key, Rob, is what's the narrative versus what is really going on, right? You look at GameStop, the numbers probably, were on the side of the short sellers. I'm not sure, why they were even short, probably numbers, but the narrative was being pushed in the marketplace. It took it a whole different direction. And so really what you want to be looking at is the data. What's really going on? Because even with GameStop, it jumped, but it really came back down to where probably, the fundamentals were. So, Connor, I don't know if you want to walk us through this, but this is a very interesting.
Yeah. So what I would say generally is, so this is 2022 results. We publish quarterly. People can see kind of how things are going. I guess where this makes the point of narrative, because sometimes narrative's used as a sort of a negative, and I don't know if we mean it that way in this regard. But one other, beyond prevalent thing in all of ESG is that a high ESG rating, top 20% rating, is kind of bestowed on, no matter what rating system you use, is bestowed on the 80% of the market cap of the S&P 500. And so what institutional investors struggle with, at least initially with all ESG data, is that if I'm going to tie it to returns, it seems like everything's supposed to go up, right? And that is not actually an error in ESG data. That is how it works. It's meant to be, as Ben pointed out, you can be a improving operational company, and for whatever reason, the stock performance doesn't happen in that year. And there can be lots of reasons for that actually don't really matter in this discussion. But the point really is that when you focus in on and have the ability to constantly sort of look at returns and what is being affected, even if you don't like the narrative, and the narrative over the last 2 years has been, hey, you should have owned high carbon stocks, basically, and then you should have owned a few tech companies. But that's what the return said. That's not how everybody's positioned, and that's not how the benchmarks are completely constructed. So, you need to have tools and methodology that can get you from ESG variables are supposed to not look like buy and sell signals that in and of themselves. They're supposed to be tied to these very important things. It's another group that ties those things to returns, and that's
and narrative. Yeah, when I meant narrative, I meant positive and negative.
No, I know.
Yeah,
I just wanted to be clear, because sometimes we say it too, actually in a negative way, which is that, if your narrative is that I ran a diverse divestment compliant ETF, so we were pretty wary of where energy would go, right? And so, depending on how you want to frame it, those are the risks you're taking on. If you're basically short energy, and over the last 2 years energy goes up a lot, well, you have to talk about that. So and that is also the other real side of all of this, is whatever decisions investors make for whatever reasons, values, quant, returns, whatever, the exposures are the exposures, and the next day you get to deal with those. And it's a constant evolving puzzle in that regard, which is fantastic for all of us. But I would say that it's just been wild in the 2020s, how much the variables in the market have changed. And if you had a narrative, if you were stuck in a narrative, rather, you'd be done. It's way too fluid. And
Fluid's a good word, a good gentle word.
Yeah, and it's the reality too. It's pretty fluid.
Yeah.
And that can be fantastic. And that actually is sort of the point, is that if you can use OWL data to short stocks pretty consistently, or at least find some stuff that goes down, well, then you can, and you have some other kind of narrative, you can probably make it work if you have the tools, or you can take what we're doing and just incorporate it into your own process, because every one of the clients that we have, prospects and otherwise, they all already have a process that we're just trying to make better. And that seems to be the consistent, honest question from institutional investors are, all these things are, according to you, all these things are going to go up, meaning the ESG rating. And it's like, well, that's not even what that rating is saying. So, right. And so then begins the conversation. Anyway.
One of the things you mentioned is your S signal. The S signal has been working quite well.
Yeah.
I think not to overly simplify, but or should say better way, at the risk of overly simplifying, and then relating it to the millennial topic, right?
Yeah.
Brand. There's been a lot of studies that show that that brand value, which is, by the way, very different from operational performance of a company, right? The perception of the strength of your brand in the market, the ability to charge a premium,
right?
Yeah, the goodwill of the brand, right? I think if you were to look at all the social topics and all the things that go into that, and the stakeholder, like we use the word stakeholder, that is very related to brand, right? Like how is the market perceiving you as a company? How are your consumers perceiving you as a company? What's the loyalty they have to you as a company? So I find that interesting, because even though everyone sees, we understand how governance relates to stock prices. and environment. Okay, everyone's focused on carbon, but as you said, if you were short carbon, you could have got hurt recently, right?
Yeah.
But everyone's focused on environmental, and everyone's like, oh, social, that's so hard to quantify. It's why is that materially relevant? To be blunt, to me, it seems obvious when you look at it from that context, right? So I just thought it was a side little side discussion here, but
and brand is, just to use a little example of someone like Warren Buffett. I mean, it took him a while to get there, and it was also pretty revolutionary idea at the time too. So it's hard to knock him, but his movement from truly a value investor to a kind of a growth at a reasonable price investor is done through a company called See's Candy, which is a chocolate company in California that Ben probably does know.
I drive by the factory on a regular basis.
So the story goes that when Warren Buffett was convinced to buy See's Candy, and it traded at premiums relative to the value metrics, he was astonished by the fact that within about a year, 18 months, the distributable cash flow of See's Candy was more than his investment. So he received more cash back, which is just unheard of. And the reason that was the case is because See's, it was obviously a well-run company, but it's because, and it still is the case, that it had this amazing brand in an ever-growing market of California. And it was an example of somebody being pushed to do an investment that was outside their value metrics, with the notion that the brand had these intangible benefits beyond what you could see in the financials. And this is the 80s. So, and I don't think Warren Buffett ever kind of think of himself as an ESG investor. However, he would say in multiples of what Ben's saying in terms of brand. And I think all investors sort of, you can do no other than just to see how much venture money has been raised to create a brand, some successfully, some not, but the sheer amount of brand that to go into it just shows that, yes, there's a lot of value to name recognition, because that next incremental sale, that next incremental whatever has so much higher volume. And in these distribution networks that we now live in, you can really get a long way with a brand. You can go into new markets. You can, so.
I wanted to relate that though. The reason I brought up the brand concept, it related to the social metric being very predictive for you. But I also want to bring it back is brand is non-financial, right? And a lot of people, when they look at ESG, it's non-financial factors. And
Correct.
I think anybody listening to this podcast can very simply go, well, brand obviously influences stock price. And yet for some people, ESG, it's a huge leap for them to go, ESG, how can that influence stock price, right? Influence, the value of a company. And it's clear it should be clear if you're looking at this objectively, that of course non-financial factors influence stock price in a big way. And if you're not looking at it, and if it's not part of your analysis, you will be blindsided. You do crowding, blindsided through ESG crowding or any other type of crowding, blindsided in some sort of way. And the analysis that Connor and Confluence are doing is they're taking all those non-financial factors and making it extremely practical and relevant to predict where its prices are going, which I think everybody needs. And it's evidenced by the fact that they have a lot of quantitative and a lot of investor clients using their analytics. And these are quite sophisticated organizations who have the capability of doing some of this analysis on their own. And the fact that they're still buying your data shows that you're doing something that's innovative, that they find value in.
Well, also maybe proving a point by doing it a different way, right? Like if you just use traditional data to prove the value of a brand, you could only do it after the fact. There's no forward anything, and there's no good indicator, using financial information. Obviously, survey data would be the way, and it would begin to look a little bit like ESG one way or another, as you point out, Ben. It's not actually how it was set up. It doesn't mean it all has to change. It means that this is yet another Evolve or evaporate is the investment process, right? And it's just it's sometimes annoying, but for people, but like we try to make it easier, and basically it's also a question of making this better for people that are non-investing types, because this information can be, the forecasts and the signals. Just because you may not trade the stocks, you are interested in what ESG variables are tied to returns, because over 12, 24 months periods, perhaps operationally, these are things that companies, consultants, others pay more attention to, with the full knowledge that it takes a long time to change operational anything at any organization. So yeah, I guess I see less pushback the way we all position it and the way we sort of work with it, where it's not so like this is going to change investing, like investing is going to be different. That's not how this is how we enhance investing. And you still have to worry about momentum and short interest if you're going to short a stock. And the whole GameStop thing has been kind of mystifying, because the one thing that is true is that whether it's illegal or not, if you're short a stock that has 140% of its float short, you're in trouble.
No.
So, and that's the part that's kind of wild, is as sophisticated as those guys were, and they were very sophisticated. I mean, literally you're playing with dynamite. I mean, just flat out, that everything we're going to show today are large cap stocks. It doesn't mean that that we wouldn't have some things that have more shorts in it, but it's very, very, very risky, and it's kind of another sign of hubris, the whole Wall Street bet. I look forward to that movie, because it's either going to be incredible or it's going to be just absolutely terrible, because it still doesn't make sense to me why people thought being long or short GameStop was some sort of like some sort of sign of freedom or anything. The whole thing is
I'll do a separate podcast with you on that.
I guess so. Yeah.
The whole thing is like Citadel they got the trades first. That's why Robinhood, everything's Robinhood's free. It's not free. Citadel front ran it. They had an algorithm that could trade on those trillionths of a second.
Oh, I distinctly remember explaining to my now 13-year-old, but she was 10 at the time, that and she was explaining how stonks worked, STONKS, and everything else. And she's like, see, Daddy, it just goes up. You were wrong. And
we should do a separate one on that.
That's a good time, like years and years of work to be told by a 10-year-old that how it all works.
It does highlight, though, sort of the weird, like, disconnected juxtaposition, if you will, between the qualitative and the quantitative. I can't help but think of how very famously about 8 years ago at a deposition, they asked Donald Trump how much money he's worth. And he said, 4 billion, 5 billion, something like that. And they're like, what do you mean? He's like, it depends on how I feel that day. And he was ripped in the press. But the fact is, for the goodwill line item on accounting, that's kind of how it works. Like, I think Nike values its brand at like 200 billion. And then they had to knock it down to 20 billion as some of the accounting. And I might be wrong in the exact specifics of it, but it's a pure qualitative number. And I've made the argument before that all risk is capital risk and all capital risk is reputational risk, really, in the end, because if everyone just I'm oversimplifying. There's obviously operational risk, but being cognizant of the fact that we're coming up on an hour, I think it's a good segue into a final question for everyone. So we're looking at narratives and the ability to tie this qualitative to the quantitative, talking about how we can provide analysis and input that services every segment of the market, no matter what your investment style is or your multiplicity of investment styles. And I want to hear what everyone thinks from your own perspective. How ready do you think the market is to start for uptake for this, to absorb it and start applying it, even at some degree? Like, what are the things you're seeing, or what still needs to happen?
Ben, you want to go first?
Yeah. I would say it depends on where geographics, right? Europe, for example, it's very central to almost everything they're doing from an investment perspective. a lot of that is not all, but a lot of it's driven by regulation. And so I guess the answer is ready or not here in the United States, here it comes, because you have the SEC climate disclosures, right? There's unless maybe Vivek gets elected, which could influence some things, but I think in general the momentum for this is not going to be stopped by any one president. There is going to be increasing ESG disclosure regulations here in the United States as well, and ready or not, U.S. investors are going to have to start taking this into account. I think they should be already, because we already know it influences stock prices, right? It's just sometimes hard for certain investors to understand how it influences stock prices, right? But I think with increasing disclosure, tools like the analytics from Confluence, data from Al, we're trying to make them more ready. And no data solution's perfect, but the more information that we have to work with, the more information investors have to work with, the more intelligent minds and companies that are doing innovative things with that data, that like Confluence, that makes it accessible, they're going to become more and more ready. And they're going to have to.
I would agree. And for that, because the market is going that way, what we're concentrated here at Al from a product standpoint is making sure our data is up to date and more accurate and more accurate and more up to date. That's what we need to relentlessly focus on here, to keep up with what's going on. And we are doing that. So, really, I see the same thing that Ben talked about, and data is just going to be more and more important. So that's what we are focusing on from a product standpoint, both in our research and allowing others to do their own research as well, empowering them to do their own research.
And I guess my take on it is, and it was awesome catching up with Ben here because of the history of this, is just sort of reminding of kind of where ESG started, where it is now, and kind of, I think both at a company level, investment level, it seems that a lot of people agree that this is valuable. There's confusion over the degree of that of the value, but that these things are valuable, and that certain aspects, it just needs to be more usable and more accessible. And that's what we're up to. And that the notion of narratives in the stock market, for example, is a tricky one because they change so much. So you have to have a process that at least delivers a lot of the menu of items that could matter. What we're doing matters a lot to us in our process, right? As Ben pointed out very rightly, two different people can use different techniques and come to very different conclusions that are right for them. And the notion is that we definitely employ a methodology that produces these types of results that make things more usable. And for ourselves, I mean, what we see ESG going is the delivering of returns and the delivering of impact and information in a more delightful way. That's more at the investment product level. And we've basically talked about it in prior podcasts with the dividend yields and portfolios, and we'll do that later with digital carbon. But I think that's kind of been my journey, but generally you see it in big ways. Companies agree that ESG is important, and they've had a version or two of it internally in their company, and now they are going to a place where this needs to be incorporated in operations and drive efficiencies over the long term, or benefits over the long term. They're not so confused, I guess, as to that, but we're all wondering what will matter return wise going forward. And I know we're all well positioned for this changing market, but I think it's also just that the market itself has gotten this education in a way, and they agree it's important. Tell me how, right? I think that's kind of where it is. Also, people want to be able to use data to do different things, and shorting or whatever, avoiding in an environment of record pricing seems to be pretty wise. I'm just as surprised as anybody else at what pops to the top in terms of, you know, whether it's Exxon or Moderna or whatever. It's more, I guess we're more from a standpoint of what is popping to the top. You know, the methodology is methodology. Like what is, and it's sometimes pleasantly surprising, sometimes not, but you know, what that model is saying now is it's not one group, it's kind of a lot of big things. And that, I think the easy interpretation there, and the month of August has agreed with this, is that, you know, Mr. Market or whatever you want to call it is taking a vacation. And you know, and has been. So we've all been working too hard while they've been taking vacation, but you know, so it's another way of being useful. And this is also where a lot of the innovations happening in finance. If it's fuzzy and hard to deal with, though, that's where the innovation's happening. And so it's fun to see how it evolves. And Owl's now a big thing. You know, 5 years ago it was Ben and a few other people. So there was no podcast, there was no, you know, so it's pretty wild. You guys are becoming a brand, and it's fun to be part of.
Thanks.
Of making that happen. And it takes, as Ben can tell you, it takes a long time. And you know, so
Well, we're going to continue. Yeah, I know. But we're going to continue, you know, keeping our nose to the grindstone.
Yeah, excellent.
So I anticipate that, and the reason I was so intrigued and excited about this is I think things like this will drive uptake much more quickly. So getting into like some psychology of economics, I think that when you talk about a carrot and a stick approach, the stick approach is much more effective, for better or for worse. But when you have a regulatory stick approach, it tends to end up choosing winners and losers. Companies that can afford to become compliant have an advantage. But when you can go to a company and say, hey, look, there's a real correlation between being negative on these factors and performing poorly, that's going to motivate changes in behavior. So fingers crossed. Gentlemen, thank you. Another fascinating discussion. Connor, obviously we love having you on. We're on our 10th podcast. You've been on 30% of them. Ben, great to have you back.
Thanks,
I will gotta move times to get you on more because it drives the discussion.
Connor, it's very educational to have you here. So
Yeah,
we need to
thank
have
you.
you back. I learned so much.
Lots of
So
fun.
thank you.
Lots of fun. Thank you,
Thanks.
Ben. It was a good time. Always.
Thanks, everybody.
So
All
yeah,
right.
if you're watching, go check out Confluence Analytics. And then remember, Owl, we are very much, hopefully we put it out there, but transforming how ESG data is gathered, analyzed, researched, and applied in every way. Freshest, most accurate, most objective, most transparent data. We're bringing it all the time. This is Rob and Nate signing out from the greatest podcast of all time with Ben and Connor today.
Yates.
There we go. Armchair ESG.
Take care,
with Nate and
guys.
Yates. Everyone
Thank-
enjoy the rest of your day.
All right, thank
Bye.
you. Bye.